Ladies and gentlemen, I've just spent the last several hours analyzing a document that dropped on January 9th, 2026, and what I discovered is going to fundamentally change how millions of people interact with their bank accounts starting this week. This isn't speculation, this isn't theory, this is a regulatory shift that goes into effect Monday morning, and the financial implications are staggering. The Bank for International Settlements published a 287-page regulatory framework that received almost zero mainstream media coverage. Yet, it represents the most significant change to global banking standards since the 2008 financial crisis. We're talking about Basel III Endgame rules that are now binding on every major bank worldwide, and these rules are forcing banks to completely restructure how they handle precious metals, and what that means for customer accounts is absolutely massive. Let me explain what's actually happening here, because if you don't understand the regulatory framework, if you don't understand how banks are capitalized and what Tier 1 assets are, you won't grasp the magnitude of what's happening this week. The Bank for International Settlements is essentially the central bank of central banks. Every major financial institution, from the Federal Reserve to the European Central Bank to the Bank of England, answers to the BIS. They set the global banking standards that determine how banks operate, how much capital they must hold, and what counts as secure assets versus risky investments. After 2008, when the financial system nearly collapsed, the BIS realized banks were dangerously over-leveraged. They created Basel III to mandate stricter capital requirements and better risk management. This framework has been rolling out in phases since 2013, but the final phase, what they're calling the Endgame rules, just went into effect this week, and buried in Section 4.7 of this document is a change that flips the entire precious metals market on its head. Starting Monday, physical gold and silver held in allocated segregated form are now classified as Tier 1 assets. That means banks can count physical precious metals the same way they count cash and government bonds when calculating their capital ratios. Until now, gold and silver were treated as risk assets with a 50% risk weighting, meaning $100 million in gold only counted as $50 million for regulatory purposes, and that made holding physical metals, capital, inefficient, so banks avoided it. But the new rules give physical gold and silver a 0% risk weighting. If a bank holds $100 million in physical metal that meets the purity standards, is stored in approved vaults, and is fully allocated with clear title, that $100 million counts as $100 million of Tier 1 capital, and this completely changes the incentive structure for banks. They now want to hold physical precious metals because it strengthens their balance sheet and helps them meet regulatory requirements, not because they're speculating on price, but because holding physical metal improves their regulatory ratios and reduces their capital requirements. Here's where it gets critical for account holders and why millions of accounts are about to be impacted. Section 4.8 addresses unallocated and paper precious metal positions. If a bank holds paper gold or silver, meaning futures contracts, forwards, swaps, or unallocated accounts that aren't backed by physical metal in a vault, those positions now carry an 85% risk weighting and require double the stable funding. Translation: paper positions are suddenly expensive and capital-intensive to maintain. Banks are being incentivized to hold physical and penalized for holding paper. And the flip in this incentive structure is going to force massive changes across the entire banking system. Then there's Section 4.9, which addresses short positions, and this is where things get really interesting. Banks that are short precious metals now face additional capital requirements of up to 10% of the notional position value. If they can't maintain these capital buffers, regulators can restrict dividend payments and executive bonuses, and this makes naked short selling economically unviable because the capital costs exceed any trading profits the bank could possibly make from maintaining those positions. The compliance timeline is what makes this urgent and why people need to act immediately. Banks have until March 31st to achieve full compliance, but they need to demonstrate 60% compliance by February 15th, And that's just weeks away from right now. We're already seeing the impact in the markets. Silver open interest on the COMEX has dropped by 47,000 contracts since January 6th, and that's 235 million ounces of paper silver being closed out in 1 week because banks are covering their shorts before the capital requirements hit them. The gold open interest has dropped by 180,000 contracts. That's 18 million ounces. And this is just the beginning because many banks are waiting until the last minute hoping they can cover at favorable prices. But when everyone tries to cover at the same time, when all the shorts rush for the exit simultaneously, the price doesn't just go up, it explodes. But here's what affects ordinary account holders directly, and this is critical. Section 6.4 mandates that banks offering unallocated precious metal accounts must notify customers within 30 days and provide 3 options: convert to allocated accounts with segregation and storage fees, liquidate to cash at market prices, or roll over into bank-issued debt securities. If you hold an unallocated gold or silver account, you're about to receive a letter from your bank telling you they can no longer offer that service under the new regulatory structure, and you need to make a decision. Option 1 is converting to allocated, where the bank actually holds physical metal in your name and you pay storage fees. Option 2 means they close your account and give you cash. Option 3 converts your metal claim into a bond that the bank issues, and you become a creditor of the bank instead of an owner of metal. And this option is terrible because you're taking credit risk on the bank. If the bank fails, you're an unsecured creditor and you might get nothing. Millions of investors worldwide hold these unallocated accounts thinking they own gold and silver, but they actually own a promise from a bank. And when these notification letters start arriving, when people realize their accounts are being restructured or closed, there's going to be a wave of demand for physical allocation. Banks will need to acquire actual metal to satisfy these requests, and that's going to put enormous pressure on available supply. Let's talk about the math, because the numbers are staggering. Global banking holds approximately $680 billion in unallocated gold positions and $94 billion in unallocated silver positions. These are paper claims not backed by physical metal. Under the new rules, these either need physical backing or must be closed. Assuming 70% get closed and 30% convert to physical, banks need to acquire roughly 96 million ounces of gold and 350 million ounces of silver at current prices. And here's the problem. Global silver mine production is 827 million ounces annually, which works out to about 69 million ounces per month. But banks can't simply buy all mine production because it's already contracted to industrial users, mints, and manufacturers. The available supply from recycling and investment selling might be 10 to 20 million ounces monthly. Over the 78-day compliance period, that's roughly 52 million ounces available. Banks need 350 million ounces. The shortfall is nearly 300 million ounces. And how does that shortfall get resolved? The price rises. The price rises until holders are willing to sell. The price rises until industrial users reduce consumption. The price rises until equilibrium is restored. And this is not speculation. This is mathematical certainty driven by regulatory compliance in a market with insufficient supply. What's happening is a regulatory-driven shift from financial assets to hard assets, and for 53 years since Nixon closed the gold window in 1971, precious metals have been treated as commodities outside the monetary system. These new rules quietly bring them back into the banking framework through incentive structures that make it advantageous for institutions to hold physical metal. This isn't a return to a gold standard through dramatic policy announcement. This is remonetization through regulatory engineering, and it's happening right now while most people aren't paying attention. The rules changed this week. The game changed with them, and millions of accounts are about to be impacted by a regulatory shift that the mainstream media isn't covering, that financial news channels are ignoring. But the banks know. The banks are scrambling, and the people who understand what's happening have a very short window to position themselves before the compliance deadline forces massive buying into a market that simply cannot provide the supply that's being demanded.